You got to put your money somewhere. You can put it in their bank or you can put it in your bank. That's up to you. If you are going to be your own bank, you got to act the part. You got to be the part. You got to put yourself in that situation where you are the bank. And that one thing that we change is where the money goes first. We're always teaching a process, right? We're not just teaching a product.
Why not just change that one thing where your money goes first? And when you really realize the power of that, you're going to want to do more and more and more of it.
What's going on, everybody? Another week, and today is the day before Thanksgiving. So there is a lot that we have to be thankful for. Number one, I'd like to give thanks to my partner in crime here, Mr. Lazy Cash, who decided to show up for this Thanksgiving edition. I'd like to give thanks to Mr. Snaggy in the house. What's up, Snaggy?
Hello, good morning, good afternoon. Happy Thanksgiving Eve to everybody.
Awesome. And then I'd like to give thanks to the entire team, my family, to God, and also to all of you, almost 100 of you, for showing up the day before Thanksgiving. So some of you are actually getting ready for the big day tomorrow, where most of us will either stay home or travel to family and be with family. And an interesting thing that I think all of you should do while you're with your family is tell them about infinite banking concepts. I'm just kidding. Actually, don't do that, because if you do, the rest of the conversation for Thanksgiving will probably not be very fun. Don't talk politics and don't talk about IBC, because nobody wants to hear about it until they actually get around this campfire, which all of you did. And listen, here's what I thought we would do today. We get questions all the time. A lot of the questions we answer in the Ask Me Anything, which is later this afternoon, but we get questions all the time. Things like, what happens if the dollar goes to zero? What happens if, the US is no longer the leading empire? What happens if the Fed is abolished and the banks fail? And what happens to my policy? And there's all sorts of crazy questions. But you know what? This is my question to all of you. What happens if you just take back control of your money by changing one thing, and that's where your money goes? And then what happens if you add one step called the infinite banking concept to your financial life? Well, I'll tell you what happens. You control the flow of your money. You control what happens with your money. Your money never stops working for you ever for the rest of your life. What else happens is your money works twice as hard for you, because your money is able to work twice instead of once. That same dollar gets to go out and make money twice if you do it right. So let's go back to some of the fundamentals, because some of you are brand new. How many of you are brand new to Wealth Webinar? Put I in the chat. Is anyone brand new on here for the very first time? Okay, we got Cynthia on here, brand new. Ronald's on here, brand new. Oh, David, Vanessa, Stephanie, Anna, Robin, Ebony, Kelly, Joyce, second time Joyce, okay? Frank. So we got a bunch of new folks. So what I always like to do is I just like to hit the basics, right? If you think about Michael Jordan, the greatest basketball player of all time, when you really got down into it of what Michael did different than everybody else is, number one, he focused on the basics. He always went back to the basics, the dribbling, the footwork. Study that. Every single day he stepped foot on the court to practice, he went back to the basics. So I thought we would just go back to the basics. So many of you might even be thinking, well, what the heck is this Chris guy talking about? I don't even know this guy's name. Who is the guy and who's the cat? Again, this is Lazy Cash. That's Stephen. I'm Chris. This is Wealth Webinar. And what we're going to be talking about today is simple: how to make more money without taking more risk, and how to do it while being in full control of your money. Sound good? We're going to go through a whole bunch of scenarios. I got a bunch of them. Steven's got a really cool scenario. You've heard of flipping houses, right? You probably watched it on HGTV. Maybe you even saw me and my wife on HGTV many, many moons ago with our show, Risky Builders. But it's so cool that somebody can flip a house in 23 minutes. Isn't that incredible? We're going to be spending the next almost hour and a half together. And do you realize there are people out there on HGTV flipping a house several times in the same amount of time that we're able to do this Wealth Webinar? It surely is an amazing thing. But you know what else is even more amazing? Is flipping houses is a pain in the ass. Yes, that's amazing. It really, truly is. It's a pain right in the butt. Number one, it doesn't take 23 minutes. It takes sometimes 23 days, sometimes 23 months. Sometimes you just never finish it. But What else is cool is flipping equipment. Yeah, that's pretty sweet. So we're going to show you a little thing that we stumbled on, because I truly did just stumble on it. And then I opened my mouth to my team, and then all of a sudden my team literally took it over like a freaking tsunami. They just went in and they started flipping all the equipment so that most of us didn't have a chance to get in. But we're going to talk about flipping equipment. But let's hit the basics real quick, because I want to help all of you understand when we talk about becoming your own bank, and we talk about not just becoming your own bank, but the infinite banking concept. I got a really simple and easy way to show you what this is. And this is how I normally would do it. On the screen right here, you've got several different things. Up in the left corner, can anyone tell me what this might be in the left corner? In the chat, what would we be looking at here? Many of you actually probably won't spend time at one of these tomorrow, but maybe. That's right. Oh, it's church. It's a restaurant. Also could be doubled down for a church as well. But if you were to talk to the proprietor of that restaurant, do you think they'd be proud of that restaurant? Do you think they'd invite you to come to the restaurant? Do you think that they'd invite your church group to come and have breakfast at their restaurant? Of course they would. They're proud of it. Do you think that owner of that restaurant goes out there and every week goes to a different restaurant to go out with their family? Or do you think they go to their restaurant? They probably go to their restaurant, right? You see, they're a business owner. This restaurant in that corner was a dream of theirs, and they fulfilled that dream by becoming an entrepreneur and starting their business. And they have put their blood, sweat, tears, and money, sometimes all of their money, into that restaurant to make it a go. So there's a lot of pride with that. But you very rarely hear about restaurant owners, unless they're shopping the competition. You rarely hear about them going to somebody else's restaurant and bragging about, oh my gosh, I went to this other restaurant. It was so good. You never hear that, right? They talk about their restaurant. How about in the middle? Many of you know what this is. That would be like a place you go get your hair cut, a salon, a barber shop, whatever. You know, that's the place where you go and you get your nails and your hair done. And the person that owns that salon is pretty proud of that too. They probably started working for somebody else, climbed up and said, you know what, it's time, I'm going to do my own business. And they went out and they created their own salon and they built it to be what they wanted, and they hired the people that they wanted working around them, but they're proud. And when they want to get their hair cut, or they want to get their nails done, or they whatever other services, they probably get all of that done in their salon. They wouldn't want their competition to see them going across the street, getting their hair cut across the street, and then kind of waving through the window, hey, everybody, you know, over at their salon. Hey, yeah, I'm just getting my hair cut. I'll be right over. Just hang on a second. That'd never happen, right? Down here, the gym. How many of you go to the gym? This is, you know, as we get into the new year, this is going to be a lot of people's New Year resolutions. Like, you know, so yeah, that's right. Gym time, reps go burr. That's for sure. So, but I want all of you to think of when you went to a gym. Did you see the owner of the gym or the proprietor? Unless you're going to one of those big chains, but like talk about like a locally owned gym. You always see the owner there. I know I go to this place called Jada Fitness, owned by a husband and wife. Every time I'm in there, I always see them. I don't care if it's 5 in the morning or 5 in the afternoon, they're almost always there. And I see them working out, and I see on their Insta story that they're always there working out, right? They're proud of their business. That was their dream. That was their thing. They would never be caught dead going into someone else's gym and working out, because, you know, if they saw one of their customers, their customer would kind of look at them being like, hey, don't you own Jada Blitz? Why are you over here at Planet Fitness? Like, what's up? Oh, I'm just scoping the competition. Really? Because you would look like you were really getting into those reps, man. Like, how come you're not working out at your gym? You guys get what I'm saying. I'm not trying to go long on this. I'm trying to get you to understand that entrepreneurs take pride in their business. So this last one right up here in the right-hand corner, can anyone tell me what that is? They don't all look like this nowadays, but that there is a traditional bank. That's right, Anna. It's a bank. And we all go into banks and we make deposits, our hard-earned money. We take our money and we put it into the bank. And when we need money for something, what do? We go basically beg them to loan us money. Oh, we need this mortgage. And you know the nervousness, especially in today's world where banks are barely wanting to lend. You know, you're so nervous. Are we going to get approved? Honey, what if we don't get approved by the bank? Oh my God, what if they won't give us the mortgage? What if they won't give us the car loan? You know, you go to the dealership, you find your dream car, and you know, it's all done virtually and online and over the phone. But just imagine you're in the bank and you're waiting to see if your credit score is going to come back. Oh boy, do we have anything new? Like, honey, you didn't just do a ding on our credit, did you? That brings the points down. Maybe we won't be able to get a car loan. But here's what I want you to think. What if that bank right there that you're looking at, when you walked outside the door, right above the door, it had your name on it? Okay, it was your bank. You owned the bank. So you got your own bank now. I want you to think about this. You got your own bank. Okay. Where would you deposit your hard-earned money? Let's say you own the bank, but let's say you go out and you do some side jobs. You do some private lending. You flip a couple forklifts and maybe a house or two too, and you make money. Where would you deposit your hard-earned money? Would you go across the street to Bank of America and deposit your money? No. You deposit your money in your bank, would you not? And if for some reason you needed a mortgage for your dream house, or you needed a car loan, or you just needed a line of credit, would you go across the street to Bank of America, or would you come into your bank and take a loan from your bank? Of course you take a loan from your bank. That's a silly question. And if you took a loan from your bank, would you steal from your bank? In other words, if your bank gave you a car loan, would you just say, hey, I own the bank. I'm not going to make monthly payments today. Nope. Not going to make them next month either. No, next month I might not make those either. Would you steal from your bank? Or would you treat your bank's money the same way you used to treat Bank of America's money before your name was above the door? Now, of course, you would never steal from Bank of America because you'd probably go to jail. And you'd never not make payments on your car, your mortgage, or anything else because you know the bank would repo or foreclose on your house. So you make those payments, even when times get tough. So if you owned your own bank, you would make deposits in your own bank, you would take loans from your own bank, and you would then repay your bank. Everything I'm going to talk to you about, everything Stephen and I are going to tell you about, everything Lazy Cash is going to teach you without saying anything is those basic fundamentals. If you are going to be your own bank, you got to act the part. You got to be the part. You got to put yourself in that situation where you are the bank. Don't think of this as anything else. Because I'll tell you, one of the biggest things that we find people doing is when they say, I want to be my own bank, and they start the process just like these folks did. And just so you all know, that's Walt Disney, that's Ray Kroc, Doris Christopher. I could put lots of other photos, but one unique thing about all three of these is every one of them are a business owner. Walt Disney, during the Depression, got turned down by just about every traditional bank for his dream. And we all know, what business did Walt Disney start? Silly question, right? Some of you are thinking, didn't Walt Disney start Burger King or something? No, he started Walt Disney World. He started Disney World and Disneyland, right? How did he start that? When all the banks shut him down and he had this great dream, this vision, where did he get the money? He went to his own bank. What was his own bank? We'll get to that in a second. How about Ray Kroc? We all know Ray Kroc didn't start McDonald's, but basically, I don't want to call it a hostile takeover, but basically created the McDonald's that we know today. But what is McDonald's? Is McDonald's a burger shop or is it a different business? Can anyone tell me what business McDonald's is? What is McDonald's in the business of? The number one thing that most people in the know, that's right. Ebony said real estate. So if you watch the movie Founder, you would have kind of seen this. How did McDonald's or Ray Kroc get into the real estate business? Well, they met somebody, but they needed money at that time. They didn't have money. All their money was going into burgers and leases and paying rent to somebody else. And he said, that guy that was with him in the movie, or whoever that partner was, said, no, we need to be in the real estate business. So what did Ray Kroc do to start the real business that McDonald's is today? Real estate. He took a loan from whose bank? His bank, folks. And what was his bank? We'll get to that in a second. Some of you are putting it in there. Doris Christopher, many of you don't know the name, but she started Pampered Chef, later sold it to Warren Buffett for well over $1 billion. How did Pampered Chef get started? First, she had the dream, the vision. She wasn't going to let anybody take that dream, but she needed money. So where did she take money to start Pampered Chef? A loan from her private bank. So if all three of these people on here and so many more started their businesses with their own bank, then you have to understand they didn't steal from their bank. They didn't use somebody else's bank and go in begging for the money because everybody got turned down. To understand the fundamentals of being your own bank, you need to act as if, right? You need to act as if you're a bank. So if you're going to act as if you're a bank, you need to understand, well, what does a bank do? I think we all know what a bank does, but let's just go through it. I know some of you have seen this 15, maybe 50 times. You can never see this too many times, right, Tess? Probably Tess or maybe Julie hold the record for the number of times they have seen this piece right here. But Tess will watch it again and again. And every time, I'll bet you Tess picks up a little something from it. Now, the unique thing about this is we've been doing this same presentation, and I'm not doing the presentation today, but we've been doing it for well over a decade, and the numbers have come full circle. So I want to talk about how you operate with your bank that you work with. Do you not make money at your job or your business and then take that money and deposit it in the bank like shown on there? And then the bank in return pays you an interest rate on your money. Now, a decade ago or even 5 years ago, when I showed 4%, I would always have to say, oh, yeah, well, let's just pretend you found yourself a really good bank, right? Because 4% did not exist. And it was almost like people were like, yeah, that's too good to be true. But how much do banks pay in interest today on the money you put there? 4 or 5%, right? Because treasury bonds and T-bills are paying well over 5%. We're going to talk about those treasury bonds and T-bills today. Hopefully, some of you were listening to me for the last year that I've been talking about treasury bonds and the inverse relationship to interest rates, because if you did listen, you had a nice little surprise when you pulled up your brokerage account the last couple of days. But anyway, getting back to this, you deposit money in the bank and the bank then pays you interest. But that's an asset to you, is it not? Your deposit, you took your hard-earned money, you gave it to the bank, and the bank put it in a box with your name on it, and they shoved it in the vault, right? And that was it. Your money is just sitting in a box with your name on it on the shelf in the vault. Maybe you've got a lot of money and you've actually got your own vault inside the vault. Is that how it works? Ronald said, nope. What do you mean, Ronald? That's not what banks do. Banks don't just store our money in the vault. No? Okay. That's right. Ronald's correct. Banks take our money that we gave up control of, as shown on the thing, and they turn that money around and make it go to work for them. And they don't even ask us permission. Not at all. The bank just takes our money, in this case, 100 grand, and they turn right around and they lend it back out to this guy whom you don't know as the depositor, but this guy and gal buy a house. The bank charges them 7% and gives them the mortgage, collateralizes that mortgage with this beautiful house. That's right. The bank puts collateral on the loan, or it takes collateral on the loan in the form of a mortgage. So the bank knows if these folks don't make their monthly payment to the bank's got collateral. They'll take it back. So the buyers of the house get the mortgage, but the money never touches the buyer's hands. It goes directly to the seller of the house. And what has the seller been taught their whole life? To put that money in the bank. So they do. They put the money back in the bank. The bank doesn't take their money and put it in the vault. The bank immediately turns around and lends it out in one of those cubicles on this BMW M4. Today, it's all done on the computer. You do computer application, the bank approves you, boom, you got a loan. And the loan is 8%. Isn't this eerie? For some of you that have been seeing this for the better part of a year, isn't this crazy that these interest rates are almost identical to what you would pay today? It'd be 4% that you'd probably earn on a bank account. It'd be 7, actually more than 7, but we'll just call it 7% for a mortgage, more than 8% for a car loan today. Boy, it's just strange how cycles work. But when you get the car loan, you don't get the money, do you? No, the car dealer or whoever's selling the car gets the money, not you. And the car dealer does what they've been taught, put it back in the bank. You do a home remodel loan because your spouse wants, I don't know, a man cave or a kitchen or a bathroom. So you go in, you beg the bank for a loan. They give you a second position loan, which is called a HELOC or an all-in-one or whatever they call them, and they charge 9%. Because why? Well, they're not in first position. They're in second position behind somebody. So it's more risk for the bank. The contractor gets the money for the renovation, puts it back in the bank, and then somebody walks in the bank with their tail between their legs saying, I am buried in debt. Oh, by the way, we are setting records right now for credit card debt. So I bet you there's a lot of people walking in asking for debt consolidation loans. The bank gives them a loan, charges them 12%. Why? Because it's unsecured or cross-collateralized. And that's a higher interest rate. So the bank's charging more because it's more risk. Credit card gets the money, puts it back in the bank. I went slow with that because we do have a lot of new folks on here. But does everybody understand what happened there? Money went in one time, went back out, came back in, went back out, came back in, went back out, came back in, went back out, came back in. Who was in control of every single one of those transactions? Was it you because it was your 100,000, or was it the bank because you gave up control? Indeed, it was the bank. And how much risk did the bank take when doing all of these loans without your permission? Shame on the bank for not asking you permission to give that mortgage, that car loan, that home remodel loan, and that debt consolidation loan. At the end of the day, that was your hard-earned money that you worked for. And the bank didn't ask you ever if you approved of those loans. So if one of those loans defaults, like, well, that's on them, right? Well, sort of. Unless you were part of the Silicon Valley Bank or Republic Bank or UBS, or I'll stop there. Oh, but there's the FDIC. Okay, so the bank doesn't take much risk because there's always the Fed who will print money and bail them out through the FDIC, but the bank didn't take on much risk. The bank was in full control of your money, but it wasn't even the bank's money. It was your money that you traded hours and dollars for. And if we just went through and did the math, this is how banks make money. They make a spread. They paid you 4, charged 7 to somebody else. Paid you 4, charged 8 for the car loan. Paid you 4, charged 9 for the home remodel loan. Paid you 4 and charged 12 for that debt consolidation loan and made a healthy spread. We add all those up. The bank made 20%. You made 4. Let me just repeat that so that it sinks in. The bank made 20 and you made 4, which means the bank made 500% more than you did. Now, I know Common Core math doesn't teach this, but if we just take the 4 that you made and divide it into the net 20 that the bank made, you get 5, which is 5 times more than you. So the banks indeed make 500% or more than you do. They're in full control. So how many of you just want to change one thing and change where the money goes first, and then do exactly what the bank did, mimic every bit of what I just showed you, but except for the bank, let's just say all we do is above the door on the bank, instead of it just saying someone else's bank, it says Robin's bank, right? Or it says Jim's bank, or it says Vanessa's bank, or Terry's bank, or Damon's bank. Do you get what I'm saying? All we're going to do is we're just going to add your name above the bank, and that's going to basically make it yours. And how do we do that? Well, we just change one thing. And that one thing that we change is where the money goes first. That's all we're going to do is change where the money goes first. And there we go, 500% more than you. Remember I said earlier, all those things, but I didn't tell you what it was. Some of you know what it was. Some of you know what your bank is, but it is not a bank. So it is nothing other than the machine that we use to power the infinite banking concept. It's a dividend paying whole life insurance policy from a mutually owned company. That's right. But now, before you kind of get excited about this and start remembering what Dave Ramsey says and Susie Orman says and everybody out there, including your advisor, says about whole life, that is and here's what they say, folks. And actually, some of you should just tell me. What do they say? That's the worst place you could ever put your money. Why would you ever put your money in an overpriced, high commission product like whole life? Right? I mean, come on. Did I nail it? Isn't that what they all say? And Dave Ramsey takes it an extra step and says, well, you'd be stupid to do that. Those damn idiots, like, put your money in, buy a term policy and then invest the difference. Exactly what he says. They don't know the truth. You're right, Anna. But that's just what they say. And that's what most people believe. Now, I know all of you on here, 124. Wow, where'd they come from? All of you on here, you aren't the norms because you're the 5%ers, because you're here the day before Thanksgiving trying to learn something new. So, let me just tell you some other things, not just those 3 people, those business owners, Walt Disney, Ray Kroc, Doris Christopher, but we could go on and talk about the Rockefellers and the Rothschilds, the Morgans and the Stanleys, all bankers by nature in one capacity or the other. Where did they put their money? I don't know, read some books about the Rockefellers, read some books about the Rothschilds, read some books about the Morgans and the Stanleys. I did a video on YouTube, matter of fact, you should just watch it, the history of IBC and all the people that have used this. They all put their money in this product that everybody says that they hate, a whole life insurance policy. But they're not the only ones. They're not the only ones, because banks, traditional banks, yes, Wells Fargo, Bank of America, all the banks that you think of, all the ones that you see every time you drive down the street. Sometimes you're driving down the street and you say, there's another one, another Bank of America, another one. Every block, there's another bank. Where are they putting their money? You ever asked that question? You ever gone into your banker and just asked them, hey, Mr. Banker, I got a question for you. This bank here, where do you guys put your money? Not my money, but where do you put your money? Like that measly 10% that the government mandates that you hold in tier 1 assets. Where do you put that money? Hopefully the banker can answer. But if they can't, I'll just tell you, and you can look this up on fdic.gov. You don't need to take my word for it, but let me just tell you. The banks put their money in whole life insurance. It's called BOLI. Look it up, BOLI. Okay. Banks are the #1 purchasers of whole life insurance in the world, bar none. And here's the proof. FDIC. Wait, FDIC.gov. That's a government website. That's right. That's the one that, the insurance company that backs your money at the bank or doesn't back your money or whatever you want to call it. That's right. Well, on September 30th, 2021, these were the numbers for just the top 5 banks. And these are old. Bank of America, Wells Fargo, JP Morgan, US Bank, PNC Bank, all banks that exist. Look at how much money they had in BOLI, bank-owned life insurance, and make no two ways about it. I don't care what the idiots on YouTube and Mr. Doug and whoever that young guy is on TikTok, what they say. They constantly bait and switch you and try to tell you, oh, banks are the #1 purchasers of permanent life insurance in the world. And then they say it's IUL. Bullshit. Sorry, I'll put money in the swear jar. It's whole life insurance. Always has been, always will be, because of the guarantees that whole life insurance provides you. But now comes the big question, and I know some of you, Anna's talking about Primerica. That's a good one. I always love talking about Primerica too. I got lots to say, but not today. Here's the thing I want to ask you here, just about this here. We only talked about the 5 banks, $75 billion in whole life insurance. Now, here's the magic question. Do you think banks and Walt Disney and Ray Kroc and the dude and, I don't know, Doris Christopher and all the other really successful people, Warren Buffett, do you think they're putting their money in the same whole life that your brother-in-law tried selling you last week or last month? How many of you think it's the same exact thing? How many of you think that whole life is whole life is whole life? There's no difference between them, right? The whole life that the banks buy must be the same whole life my brother-in-law tried selling me from Northwestern Mutual, right? Wrong. Banks policies, these BOLI policies, you can look this up. They're designed and engineered completely different than a regular off-the-shelf whole life. Absolutely. I'm not saying regular whole life is bad. It's actually pretty good, but it takes a long time for regular whole life to actually make any money. Why? Well, primarily because, number one, a regular whole life does pay a really good commission. How much? Well, ask your New York Life agent or anyone else, or actually, I'll just tell you, I used to work for New York Life. It was 55% of the premium. So let's do the math. If you put $10,000 in premium into a regular whole life, how much did that agent make? The minimum is $5,500. That's why Dave Ramsey says, oh, the only one making money is the insurance company and the damn agents. Right, in regular whole life. Now, let's just say we designed and engineered that exact same whole life. Okay, and I'll just pick on New York Life. Let's say we did a whole life, but we designed it backwards. And we literally designed it to work for banking. We designed it to work for high early cash value, not the maximum amount of death benefit. So in doing that, how would we do it? And I got videos on YouTube. So subscribe to my YouTube channel and find the video that says how to design an IBC policy updated. I peel the curtain back and I show exactly how we do this. But what we do is we put the lowest death benefit on the policy. That's right. We're literally putting the lowest death benefit. Well, isn't this life insurance, Chris? Why would you put the lowest death benefit? Well, because Dave Ramsey said that the death benefit in whole life is expensive. So we're going to put the lowest death benefit on. And, then what we're going to do is we're going to take the most amount of money we want to save. So whatever amount you're saving now, we're going to change where that savings goes first. And we're going to plop it all into the whole life. So we're going to shove a ton of money into that whole life policy, but we're going to put it into a special rider. A rider that goes to the insurance company's general account to get some of those good old returns that those insurance companies know how to do, because they've got how much money? Well, I'll tell you in a second how much one of the companies has, and I'll do that in just a second because I've got their balance sheet and their income statement, because a lot of people are like, well, what happens if the insurance companies fail? Well, let's talk about why they don't fail and why you probably can't find any insurance companies in the last 100 years, mutually owned insurance companies, that have failed. Well, it's because they know something you don't know, but they know how to invest conservatively for the long haul. Banks don't seem to know how to do that, do they? Doesn't seem like it, because a lot of banks go bankrupt when recessions hit. And that would say that they're just taking a little bit too much risk. But anyway, back to the specially designed whole life. So we put the lowest death benefit on. We shoved the most amount of money into it. But since 1988, the government got a hold of this and said, hey, guys, we can't let you put all this money in that whole life policy because it's all tax-free. Any growth you have on that money is tax-free. And IRS, we know that. So we're going to limit the amount you can put in. And how we're going to do it is through this thing called a MEC 7 pay. What we're going to do is we're going to mandate that you have a certain amount of death benefit in the policy to support the amount of deposits, premium deposits you're going to put into the policy for a period of 7 years. MEC 7 pay, 7 years. Okay, that's how they do it. So what we had to do is we had to sit back and go back to the drawing board and say, all right. So the IRS is making us put more death benefit on, but more death benefit costs more money. And Dave Ramsey said whole life's super expensive. And those commissions. Dave Ramsey said term is cheap. Okay. Hey, insurance companies, you guys got any term riders that we can put on this whole life to get it up to that death benefit that the IRS wants to meet this MEC rule? And the insurance company says, sure, we do. How much would you like? Well, I would only like the minimum amount that I need to support the IRS rule, right? Okay, well, we'll give you $745,219.42 because that's what the IRS requires. Yeah, give me that. Well, and then the insurance company comes back to us and says, well, how long would you like that on the policy? Oh, that's a good question. How long? Well, what are my options? Well, you can do it for 5 years, 10 years, 20 years. Hey, we even got those 30-year term riders. Which one would you like on here? Well, hold on. Cost equals drag equals less money and growth. So we want the lowest cost. The lowest cost one is what? Well, it's the shortest one, of course, because we take less risk. Okay, great. So the IRS says we need that term, that death benefit for 7 years. So you got any of those 7-year term riders? Oh, you do. Yeah, let's do it for that 7 years. Or maybe we'll do 10 years because we want 10 years of maximum funding for this thing. The insurance company says, sure, we'll toss one of those term riders on there for 7 or 10 years. So now what we've literally done is we've taken and designed and engineered a whole life policy that is really front-loaded with cash and allows that cash to immediately grow and immediately be available for use without all the extra costs. Because Dave Ramsey taught us, right? Dave Ramsey didn't teach us that, but anyway, I'm just giving him credit. Dave Ramsey told us term is cheap. I know I went on a little tangent there, but listen, the whole life that everybody else is trying to sell you, that's not the whole life that we're designing for IBC. Because it wouldn't look like this. Check these numbers out. This is a real client. His name was Kevin. I can't give you his last name, but he was a young guy. He was 38 years old when we met him, actually 37, 38 insurance age. And when he saw one of the presentations like you're having or hearing here, he said to us, he said, hey, all right, listen, like, I got like, he had like 70 grand in his bank, but he said, can I take like 50 grand of this money that I got sitting in the traditional bank earning nothing? Because back then it was earning nothing, zero, literally zero. And he said, can I put that in the whole life and earn the interest rate? And this insurance company here paid 5.2%. He's like, well, 5.2 is way better than zero. So yeah, I want 5.2. And we said, sure, it's called a dump-in. Let's dump that 50 grand in the policy. And he said, yeah, well, hold on though. That money, I need that money. You see, I've been saving this money up. I'm looking at this to buy this duplex. I just haven't found a good one yet. I need that money to put down on a duplex. Am I going to have access to that 50? Because I can't put 50 in if I can't use that. I said, Kevin, listen. You put 50 grand in, you're going to have access to that money immediately in the first 30 days. It's not going to be all of it, Kevin, but you're going to have access to about 90% of that money immediately in the first 30 days. Is that cool? Like, will that work for your duplex? He said, hell yeah, that'll work. I said, all right, Kevin. And he said, all right, what else do I need to do? I said, well, how much would you like to deposit every month or every year into that policy? Because not just the dump, we can't just do a dump in, that would mech it. We got to put money in every single month or every single year as savings. He's like, oh yeah, well, I was saving money in that bank account. I was doing 500 a month. Can I just do the same? Sure, Kevin. You want to do 500 a month? Great, whatever you want to do. So Kevin puts in $500 a month. So let's just look at the numbers for Kevin. Kevin puts in the first year, he puts in $55,895, 50 plus 58.95. We couldn't get exactly the 500 in, so we put 491.25. So how much money did Kevin have available that first year? 51,554. What kind of a percentage is that? It's about 92%. So Kevin had 92% of his deposit available in the first year. Now, I did not say 100%, did I not? So any of you that are the folks that love to go into your traditional bank and make a deposit at the beginning of the year, but you rush back into that bank December 31st and you take all your money out, and then when your friends say, well, why did you take all the money out? Just so that I could prove a point and say I could take all my money out. Did you need that money for anything? Nope, just wanted to prove a point. Great. This won't work for you if that's you. But for most people, the money they put into the bank, they don't ever take all of it out. So 92% was fine by Kevin. But see, here's the benefit. This isn't always going to be the case for every single one of you. I want to point out a couple of things, and then I love the chats coming in, folks. Hopefully I'm not going too deep into this, but this is some really important stuff, and then we're going to give you a bunch of real life examples in just a second. But Kevin put in 55,895 and he could take 51,554. So here I want to ask everybody a question. If Kevin took out that 51,554 to lend it out, actually, does anyone in here need 50,000 bucks? Anyone? Just put 50,000 in the chat. Does anyone need 50 grand? Anyone? Okay. So Boyd needs 50 grand. No, Boyd was first. Vanessa, we'll get your 50 for you too. This is a bank, and you know what? There is now 125 private banks on here right now. Holy cow! Look at all, Stephen, look at all the people that need 50,000 bucks.
Oh yeah.
Holy smokes! All right, you should be writing those names down. Everyone on here, I want to pause for a second because this is miraculous. I just want everybody right now to see all these names. Boyd, Deborah, Vanessa, Anna, Christine, Ebony. Holy cow, there's a lot. Marion, Patty. I'm going to miss some. But all right, every one of those folks needs 50 grand. Now, let's go to the second question. Now, Kevin's not going to just give 50 grand to anybody. Kevin says he needs 12% on his money, and he will lend it out for a year. And at 12%, he'll lend 50 grand for a year. How many of you that just did that? I got to go to the bottom. Now, how many of you need 50 grand at 12%? Put 50, 12. I'll give that to you, Jeff. All right. So Jeff beat the punch. Actually, Deborah was first. So, all right. So we're going to go with Deborah here. Deborah needs 50 grand at 12% for 12 months. Okay. And I bet you the line, look at, they're all coming in 4. So Kevin takes that 50 grand from his policy immediately in the first 30 days and gives it to Deborah. Deborah then immediately gives Kevin back interest payments on that 50 grand, which if we just take our calculators, and I probably should be able to do this math in my head, but I'm just not trying to be smart today. So we take 50 grand times 0.12, that's 6,000 a year, divided by 12 is 500 a month. So every month, Deborah is going to give Kevin $500 a month. Let me ask a question. First off, Kevin took 50 grand out. How much money's left in Kevin's policy? Anyone know? He started with 55,895, but he just took 50,000 out immediately in the first 30 days. How much money is left? That's right, Ebony. That's all of it. All of it's left in there. You're absolutely correct. 55,895 is left. Some of you are probably a little confused, especially if you're new. You're probably like, whoa, 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 whoa. No, no, no. You're trying to play a trick on me here. Dave Ramsey said you guys were going to do this. You guys are scam artists. Dave Ramsey said you're going to tell us things that aren't really going to happen. So you put 55,895 and you take 50,000 out. How can there still be 55,895 earning interest and dividends in that policy? That doesn't make any damn sense. Makes all the sense in the world. You're the bank. So when you took that 50,000 out to give it to Deborah, whose money did you give Deborah? Well, it wasn't yours. Okay. Does a bank, a traditional bank, use their own money when they lend money out? Hell no, they use your money. So we're not going to use somebody else's money. No, no, no. We're going to play a different game. See, remember, we changed where our money went. Kevin changed where his 55,895 went first. And then what Kevin did is Kevin took a loan from the insurance company. Okay, mark my words, a loan from the insurance company and gave that loan to Deborah, which means Kevin's 55,895 is still in his account, earning 5.2%, compounding interest, uninterrupted. But you're probably like, whoa, 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 I don't want, listen, I'm trying to get out of debt here, Chris. I don't want to take more loans. Oh, no, no, that's okay. This insurance company, which is one called Lafayette Life, one we use a lot, okay? They're never going to ask you for that loan back. Now, they are going to charge you interest on that loan. But why would the insurance company ever give you money, 50 grand, okay, and charge you 5%? Why would they ever do that and just not want it back? Like, that doesn't make any sense. Round number 2, pay attention. Every insurance company, especially whole life, not term insurance, but whole life, any permanent insurance company would be glad to give you that. Because the insurance company made a second promise to Kevin, which I don't have it up here on the screen, but they promised that if Kevin died tomorrow, they're going to pay a death benefit to his family. So Kevin put 55,895 in. His death benefit's probably like 500,000. That's a blend of whole life and term. It's probably about $600,000. So if he dies tomorrow, 500 grand, we're just going to use that number, goes to his family. But if Kevin takes $50,000 as a loan from the insurance company, what the insurance company does is actually goes to the death benefit, subtracts 50 grand from the death benefit. That 50 grand that they have to pay when Kevin dies, that's the money that Deborah got. So literally the insurance company loaned Kevin part of his death benefit while he's living. Hence why he doesn't technically have to pay it back, although we do teach you to be an honest banker. Remember, I said never steal from your bank. We teach you to repay your loans, but not because you have to, but because you should, because it's your bank. So that 50 grand, if he never paid that money back, the insurance company would charge him interest on that money at a rate of about just under 5% by today's numbers, okay? They would charge interest, simple interest, while Kevin's earning compound interest. And then not only would they charge him interest, when he died, they would get their 50 grand back because they would just subtract it from the death benefit. Does this make sense now? But here's the thing you maybe didn't pick up because I purposely tricked you there. Does anyone know how I tricked you? I planted some numbers in your head that now those are the only two numbers you can think about. Kevin's making 5.2% interest and dividends, but Kevin's paying 5% on the loan. You think Kevin's making what? 2 basis points? Hardly worth your time, right? Who would do that for 2 basis points? But hold on. Remember I said Kevin's money never left his account, which means Kevin's money's compounding on uninterrupted compounding interest, meaning he's earning interest on interest and dividends every single year, and it grows on a compounding basis, where the interest he pays on the loan from the insurance company is simple interest. So let's just do the math by his numbers. Year 2, Kevin puts $5,895 in his policy. Again, transparency. Kevin is young. Kevin did a large dump in, a low premium deposit. So therefore, this is a very efficient policy. Yours may not match these numbers. So I'm just being honest and as disclosure, letting you know that yours might not match, but this is Kevin's. He could take out in that second year, $7,141. Some of you heard those numbers, right? He put in $58.95 and takes out $71.41. Put in $58.95, took out $71.41. He made $1,246 in his second year. Yeah. Oh, but remember, in the first year, Kevin couldn't take all of his money. So the second year, he made $1,246 of that money back. So if we take $1,246, his net gain, net of commissions, net of cost of insurance, net of policy service fees, I always say net, net, net. He takes that $1,246 and he divides it into the amount of his deposit that year, $58.95. Because remember, the rest of the money he loaned out to Deborah. Deborah's paying him 12% on that money already. Okay. Remember that. Don't forget, Deborah's got 50 grand of Kevin's money. So Kevin gave Deborah almost all the money he had available to use, and he's making 12% on that. And he's taking the 12% interest that Deborah gave him and putting it back in the policy as a loan repayment, which I'm not showing here. But the second year, he's now got $7,141 that he can use. So let's just say he pays off a credit card. Kevin takes $7,141. He pays off Visa. What was his return on that money? Well, $1,246 divided into $58.95 is 21.14%. Yeah, but you got to give the insurance company 5% of that. Yep. So subtract 21 minus 5. Anyone upset with that return? How about the fifth year? 26 minus 5. You upset with that return? 10th? 54 minus 5? Are you picking up what I'm putting down, folks? Do you see what compounding interest does? You see, when one is simple and one is compounding, this is what happens. But it doesn't happen fast. This is not a get-rich-quick thing. This is a get-wealthy long-time thing. Love me long time, I think they used to say. I don't know, whatever. What do you say, Cashy? But you see what I'm saying? You didn't get rich quick here, but you found a secret. You learned something you've never been taught. You found a way to make money twice on the same dollar. And you also found a way to allow some of your money, your savings here, to grow in a tax-free environment. Now, Deborah's 12% that she's paying him, $500 a month, is going back paying the loan down. So you all are still fixated on that 5%. But is he really paying 5%? Well, let's debunk that one. This is something that a lot of people screw up on all the time because they think, oh, it's 12%. And then we're going to get into some neat examples, okay? This is a calculator that our team created. Craig created it. We're just going to put 50 grand. That's the amount he gave Deborah. Gave Deborah 50,000 bucks. All right, so each month, remember, Deborah was giving him $500. And why would Kevin not put the 500 back into his bank? He wouldn't go to Bank of America and put that 500, right? He's got his own bank. He doesn't want to steal from his bank, and he doesn't want to deposit money in somebody else's bank, so he's just going to put it back in his bank as a loan repayment. Now, every single time Deborah gives him 500 bucks, and Kevin puts that $500 back into his policy, who can tell me how much money Kevin has to use as soon as that check clears? Because remember, he owns the bank. Deborah gives him 500 bucks. He puts it back into his policy as a loan repayment, paying his insurance company loan. That's right, Boyd, 500 bucks. Okay, 500 bucks is what he has. But see, I want you to look at one thing specifically. I want you to, and actually this calculator doesn't have it. Damn it. All right, but anyway, yeah, I pulled the wrong calculator. It's okay. So every month he's paying $500 down. Do you see the balance here? $45,838 after the first year. So let's just do the math. So he's paid his loan balance down, $45,838. So he has almost $5,000 that he's recaptured into the policy, plus the interest and dividends that he's earned on that money. But now let's just figure that out. All right, so do 40. I'm just going to do the math. Take 45,838. That's how much is left on his loan. And that's how much the insurance company is charging him in interest on that 13th month. So let's do 45,838 times 0.05. Okay, that's 2,291.90. Now let's divide that into the original loan of 50,000. Can anyone see that? That is 4.5%, a little smidgen over 4.5% interest. Effective. Does everybody know how I did that? Okay, I did it manually. Normally the calculator would do it. I just pulled the wrong calculator. Did you see what happened? Because Kevin was an honest banker. Because Deborah's $500 a month went back into Kevin's policy as a loan repayment. He's not paying 5% on 50 anymore. He's paying 5% on 45,838 shown right here. Or he's in his, let's see, here we go. In his third year, he's paying 5% on 41 or 5% on 37. All loans work this way. But his effective payment that he's making, his effective interest rate is now only 4.5%. In the third year, if he just continues to do that, right here, if you did 37,954 times 0.05, that's 1897 divided into 50 grand. That's 3.7. We'll round it up to 3.8%. So what is 3.8 minus 5.2? What is 4.5 minus 5.2? Isn't it more than 5 minus 5.2? You see how I did that? I planted numbers in your head so that you thought about it and you actually thought negatively. You're like, oh, why would anyone do this and go through all this work to make 20 basis points? But you see, then I actually showed you what you're actually making, the cash on cash return, but then I actually showed you what you're actually paying by effectively being the bank. But some things had to happen there for all of that to work. And that's what I want to use Stephen's example to show. I really want to go back and I want to pull Stephen into this because we're going to look at a whole bunch of examples. But Stephen, were there any questions on that stuff? Is anyone confused or did everybody kind of track what we did? We changed where the money went. We added one step, which is basically the infinite banking concept. We took back the banking functions, didn't allow other banks to get any of our money. We kept it all in a closed system. And because of that, we made a spread, just like the regular bank did. Remember I said, all you're doing is you're changing the name on the bank. You made the spread. Oh, and if you die, you get a death benefit. Sure, that's a bonus.
Yeah, no, just some people asking about the 90-minute video. So I posted the YouTube link as well as the link to schedule a call with one of our money mentors. So after you watch the 90-minute and fully grasp, write down your questions and get on a phone call and we'll be able to walk through it with you, answer all your questions and see if it makes sense. And somebody's just asking to show maybe a couple examples of like a 90,000 dump in, 12,000 premium.
Okay. Do you mind if I just show this one here real quick?
Yeah, and I did just get an approval come through an hour ago on one that was like 150,000 and 15, pretty close. So here, I can just show that.
Yeah, here, let's go rapid fire, folks. So you guys, we got all sorts of examples here. Here's one. Okay, this is one we did. This is a policy. It's a business owner, actually. Same company, Lafayette Life. They put 100 grand in and 23,000 a year. They put 123 in. Their guaranteed cash that they can use is 110. After we add a dividend, it's 114. So how much is that available amount that they can use in this policy? This is a 36-year-old, 93%. The second year, they put 23,000 in, and how much can they take out? 24,460. How much of a return, cash on cash? 106, then 111, then 117. And look at the death benefit. The death benefit even goes up. Some of you are like, whoa, Chris, what happened here? Why did we go from 2.3 to 766? Well, we didn't need the term insurance after 7 years. Remember, Dave Ramsey said, like, the cost of insurance kills you. So let's get rid of the term. We don't need it. And look at our return. We go from 137 to 152. We got rid of the cost of that term. And then what happens? The death benefit just keeps regenerating itself. It gets back up to $2 million automatically by 62. And if you live to average expectancy, let's say 80, you're at 3.6 million. All right, Stephen, I showed you mine. Now you show me yours.
Yeah, this was a 51-year-old standard rating. So you can see male 51 standard, 140,000 goes in the first year and just under 130,000 of that available to pull back out via loan. Second year, 15,000 goes in, can pull out more than that 15,000 already in the second year, 15,787. And you can see how this thing grows, every year. Down here, we get to the 11th year, 62 years old. So a lot of people retire around that time, put 6,700 in, can pull over 19,000 back out. So this thing really starts to vamp up and go pretty quickly.
So Robin, that's pretty close to what you're asking. 90 and 12. Your numbers would be almost identical. I mean, no, I know they're not exact, but we did one with 100, not 90, but close. 100 and then 20. What was mine? 23,000, I think. Yeah, 23. Stephen, yours is one. What would that be? 125, 35, 40. Yeah, 125 plus 15. So yeah, same things. So Robin, hopefully that helps. Those are both Slayers, I believe. Stephen, was yours a Slayer?
That was a Lafayette policy, yeah.
Yeah, there's a Slayer or Beast. It's one of the two. It's a Beast or a Slayer. Some of you are like, what the hell's a Slayer? What the hell's a Beast? You got to watch the video. So subscribe to my YouTube channel, click the little subscribe button, smash the bell, and watch how to design an IBC policy. I'm getting good at that call to action. I'm going to show you this one. I can't tell you the name or who this is, but I do want you to kind of look at this, and then I want to show you some applications. Is this stuff fun, folks? You guys learning something? Yeah, we love the Rock. The Rock just doesn't work in all scenarios. The Rock is a creature of our design, and it's still being designed and modified and tweaked.
Yeah,
So
and to Drew's point, that was Drew. The one I showed was actually a 65-35 all the way through.
Slayer. So folks, what I'm going to show you now, don't get hung up on a lot of numbers. These are, take the illustration that you just looked at. We showed you a bunch of illustrations, but now we're going to show it actually going to work. So all of you are going to have different things that you're going to do with your money. But let's just assume that every single year you put money into the policy, you're going to take that money out. Okay. That's all I want you to know. This example here is you put money in, and every year you take the most amount you can out, and you make that money go to work for you at a rate of 12%. I can't remember, this one might only be 10%, but whatever, 10 to 12%. Where can you get 10 to 12%? Privatemoneyclub.com. There's deals on there every day, 12 and north of 12. You could get a hold of the Fullers at ROI Property Group. If you got 100 grand or more, they start at 12%, okay, and personally guarantee all their loans. Where else could you earn 12%? Well, you could pay off credit cards, guarantee you're going to make more than 12%. I bet you some of you have car loans that are more than 12%. Bet you some of you have unsecured loans out there for one reason or the other that are over 12%. So there's lots of places you get 12%. So I don't want to pigeonhole you saying you just got to lend the money. It could be whatever you're doing. But here's a really cool scenario. Again, I'm going to give you one example, show you all these numbers because there is a lot of them, but I want you to just see each one of these just means end of year, year one. This particular client, okay, put $500,000 in dump in money, and every year wants to put $500,000 in. So $1 million in the first year, and then $500,000 each year. They immediately take a loan. So they put $1 million in, they take 881. It's about 88%. Okay. And they send that money out to work earning 10, or we'll just call it 12%. I don't know exactly what it was on this example. But then they got interest to the insurance company of $44,000. Okay, I want you to pay attention. This is how much the insurance company is going to charge them, and this is how much money stays in the policy. So you put $1 million in, 881 is the amount you could take, but 46 is still in the policy. You just can't take all of that immediately. Total death benefit in this one is 13 million, and the remaining death benefit after the loan, because remember we're taking a loan from our death benefit, is 12. The numbers are always going to be the same in every one of these years, okay? But then down here, we find an investment, a private loan, a credit card, a loan to pay off, where we're going to make 12%. So we take the 881, and that 881 earns us 105,000. What do we do with the 105? Well, we basically take the 105 and we basically roll it into the loan, okay? 105 yearly gain, average cash flow, 8,813. Okay, capital deployed was 881. The amount you made is 105. We got to subtract the 44 from the 105. That's $46,000 left. So right down here, our net proceeds were 981. In this scenario, in the first year, you lost 1%, 1.06%. Now let me ask all of you this. If you had $1 million and you did this, and your first year you lost 1.06%, you lost, but you picked up $12 million of death benefit for your family. Would you be okay with that in the first year? Is anyone not, actually, let me re-ask that question. Is anyone not okay losing 1.06% for getting $12,788,532 in death benefit? It's kind of a no-brainer, right? Okay, so now we're only gonna do a couple of years, okay? Year two, we do the same thing. 500 goes in, we take 477 out, we pay the interest on the loan of 67,000. And then we've got 13 million in death benefit. We now have 1.4 million out there earning 12%. Okay, the yearly gain we're making on that 1.4 is 170. Okay, down here, 170 minus the loan interest that the insurance company charges of 67 nets us down here a 6.29% return. 2 years using the infinite banking concept. Okay, that's all we're doing. You guys, some of you guys and gals do this every single day. You're doing this, but you're doing it using someone else's bank. Okay, which your numbers cannot work this way because you can't take money out of a bank. In other words, you can't go into a bank and give them 500, 30 days later, take 477 out and expect the bank to pay you interest and dividends on 500. It just doesn't work that way. Therefore, traditional banks, if you use them, or traditional Wall Street accounts, if you use them, can never, ever do what I'm showing, because only an insurance company will pay you interest and dividends on all of the money while you're able to use it. Hence, how you can make 6.29% the second year. So we made 6.29%, plus we got 13 million. Now, the same exact thing. We're just going to keep going. Everybody understands what's happening. Third year, you make 13%. Fourth year, 20. Everybody understands that this 20.99%, remember, your investment's making 12. Okay, your investment's making 12. You're paying the insurance company's interest out of the investment that paid you 12 right here. Okay, you made 323. You had to give 119 to the insurance company. You net 20.99. How can that be? The next year you make 28.97, then 37, then 46. I just want you guys to see this. 46, 62, 80, 100, 121, 145, 172, 201% return in year 14, net of commissions, net of cost of insurance, net of policy service fees, net of loan interest that pesky, nasty, expensive insurance company charged you. Does anyone have any questions on that? Folks, listen, like when people try to tell me that this doesn't work and that's a scam and there's no way this works and that's stupid, and they sit there and try to be smart and, oh, an IUL should be used instead. I know these numbers. I've done this enough times, and I just think to myself, I say, you poor, poor person. I feel so bad for you because you're unwilling to learn something new, and what you're giving up, you never comprehend how much that is that you're giving up.
Breaking news, this just in. Are you sick of having your money lying around not doing anything? Well, we've got the solution for you. PrivateMoneyClub.com. Back to you, Chris.
Folks, I just want to take 1 second, then I'm going to turn this over to Steven because he's got something really cool to show you. But I want to just talk about something that we got in the mail. Many of you probably got this. Since we've been talking about Lafayette, we're not doing a Lafayette commercial. We use One America, we use Guardian, we use Security Mutual Life. We've used Penn Mutual, we've used Mass Mutual, although we never do anymore. This is just one of the companies. You see this? This is Western and Southern Financial Group's 2022 annual report. Oh, look at Cashy showed up for this. Cash, check these numbers out, dude. Look at this insurance company's numbers. You want to, like Warren Buffett looks at financials, right? So here's the financials, but I know those are probably too small. So let me just read them to you. I just want you to all understand how big these insurance companies are. And Lafayette's not the biggest, but they're one of the top 5. 2022 year end. Who can guess what their total revenue was? Anyone know? Anyone want to take a stab at what their total revenue was? Big mutually owned insurance company, a boatload. Anyone want to put a number to it? Okay, you're close. Okay, yeah, $6.1 billion. Okay, but hold on. How much in assets do you think that this company has? Assets used to pay back liabilities. If you die tomorrow, like how safe is your money? If you need a loan from your policy, how safe is your money? Anyone want to guess? 24, I love that. 67,482,517,000. Sorry, I lose track of that. And how much do you think they net after all liabilities? Now, what are liabilities to an insurance company? Death claims, okay, right? Benefits and things that they promised, future policyholder benefits, notes payable, other general account liabilities, liability related. How much, if this company literally had to liquid, if everybody died and everybody called every note that this company has, how much do you think would be left? What is their equity? You know, and if you're Warren Buffett, this is all you ever look at. You look at assets minus liabilities equals equity. What do you think is left? 32 trillion. I wish it was that much, Kelly. 5 billion? You're close. 9,031,109,000. Or if I said that right, 9,031,109,000. Yeah. Anyway, we'll just call it 9 billion for rounding purposes, right? This is what all these companies look like, folks. This is what they all look like. This is why these companies don't go belly up. This is why these companies don't go defunct. Why do banks go defunct? What do you think a bank's balance sheet looks like? Not this. Banks don't have any money. They have your money. They only keep 10%. Remember, Silicon Valley Bank went belly up when there was a small run on the bank. Why? Because interest rates. That's it. Because interest rates changed. That's the only reason. Sorry, Stephen, I'm on a roll here, but can I just show one more thing?
Yeah.
I don't want to show this and offend anybody, but I know some of you have been around this campfire for a little while, and I've been telling you, buy treasury bonds, buy treasury bonds, buy long-term treasury bonds. They're the cheapest that they've ever been. Pretty soon the Fed's going to reverse, and they're going to start either holding rates or dropping rates, or they're just going to change policy, the monetary policy. They can't always keep raising rates. There is a chance they'll do one more rate increase, but I just want to show you something here because this just proves everything I've been saying for a year, and a lot of people probably have doubted me. So just look right here, okay? 6 months. The return on this has been negative 9.87%. So if you bought this treasury bond 6 months ago, you're down 9%, okay? Which is okay because you bought low. Look at this, buying low, buying low, buying low, buying low. See what happened here? Uh-oh, what happened? Okay, this is just as of October 31st, straight up to November 22nd. So if we go there and we go 1 month, in 1 month, it has turned around and made 7.77%. Why? Because we're starting to see that change. In headline news today, headline news, CNBC, it said that treasury yields are going down. That is a sign, a very clear sign that we're entering some pretty rough times, okay? A lot of times some would say that's signs of, a recession coming, signs of, a bear market coming, whatever, but yields are going down, which means the price of the bonds are going up. That's why we buy them. So right here, you're seeing this. The turn has begun to happen. And you can see it if we go max, see that big spike? Now, all we need to do is we just need the Fed in the next couple of years to drop interest rates down to close to zero. And how much money do we make? Well, I don't know. If you bought them today at 90, this is just an ETF. If you bought this at 90 today, I'm not making a recommendation or a suggestion or giving financial advice. This is just one that I own. And it went to where we did when the Fed dropped interest rates to zero during the pandemic. So let's just assume it just goes back to the same place that it did, which historically it always goes higher. But okay, what would that be? 169. Can anyone do the math? What's 169 minus 90? All right, anyway, I'm done. Enough. It's enough. On to you, Stephen. What do you got? Let's talk flipping forklifts.
All right, so we get a lot of questions. Hey, like what happens after I pay off my debt? What do we do with this policy? What do we do with all this cash value in there? So obviously we're just showing examples of private money lending, and we do a lot of real estate transactions and deals. We invest into our businesses and things of that nature. But there's, as Chris alluded to, we found this company that buys and fixes up and flips equipment. So things like forklifts, for example. And so we decided to Chris was the guinea pig, I think, on the first one, right, Chris? And then you said, you kind of told us about it. And then everyone on the internal team, was like, all right, we'll become the guinea pigs just to see if this works. So here was the first transaction. I'll just show you guys what this looks like from start to finish on the on what this looks like to do this. So when you call up this company that flips forklifts, the guy's name's Arcangelo. And at the time, he was allowing smaller amounts. So right now he wants closer to like 100,000 to do this, to buy multiple lifts, just because of how many people are wanting to do this. But at the time I said, all right, I'll start with 2 lifts. And those 2 lifts, you can see, send me the invoice. It was a 2012 Yale. And actually when he sent it, you can actually click a link and see pictures and stuff too. But so he sends you the forklifts, the serial number, exactly what you own. You can see the cost, $12,350. And then the second one I bought was the 2015 Toyota model for $18,600. So I received an invoice from him for $30,950. I clicked that. I paid it after signing a DocuSign as well, which is a remarketing agreement to make it all legal. So you can say I paid the $30,950 on 4/18. Chris, can you just write down these dates so we can do the calculations in a minute for the math? Okay, so the total number is, Chris, $30,950. Actually, here, let's break it out between the two of them.
Okay.
Forklift number 1 is a Yale, 2012 Yale, $12,350.
Okay.
Forklift number 2, 2015 Toyota, for 18,600. I paid for those on April 18th. Here is the 2012 Yale sold first, and that's sold on July 19th. So Yale sold July 19th. Okay, so you can see in here, they didn't do any paint work. They put $3,500 in parts on it, $400 in tires. You don't have to write this down, Chris. Just
okay. I was just putting how much it sold for.
Okay, cool. $400 in tires. So you can see the cost of the lift. That's what we wrote down a minute ago, what we paid for it. Shipping to the customer was $1,300. The dealer pack is $750. Salesman commission $621. So you can see a total of $18,925 is what we had in this thing. They sold it for $22,050. Okay. So that's a $3,124 total profit. Now, the way that this works is when you do this, United Lift keeps 60% of the profit, and you as the private money lender keep 40%. So 40% of that profit is $1,249. So Chris, if we can do some math real fast, I paid $12,350 for it on April 18th, and I got back $13,599.65, which is $1,249.65 on July 19th.
Yep.
So that's May, June, July. So exactly 3 months and 1 day later.
3 months. I think if I did it right, 3-month percentage return was 10%. Divide by 3. That's 3% a month times 12. That's a annualized 40.45% return. Did you get the same?
Yep, about right at 40%. So annualized return, 40%. Obviously, the downside is a very short term, 3 months. Then I get my money back, and now I have to do this again with ARC. However, once you develop the relationship, as the money comes back in, all we can do is start buying more forklifts with them. So your money might sit, I've seen on average, anywhere from, it usually takes ARC usually about 2 weeks to 30 days, I would say, to find a new lift for you. So even if your money's sitting for a month at a time, every 3 to 4 months, so you're still looking at about a 30% annualized return, even if you include the time your money's sitting. Now, again, this isn't guaranteed. This might not even necessarily be common, but I'm just showing you my personal exactly what happened. So let's do the math on the second one real fast, Chris. So the second one, again, we purchased for $18,600. So this one produced a profit of $1,505 to me. And this one sold on July 24th.
1,505. What
So it was
July 4th?
3 months and a week. So a little over 3 months.
3. So 1,500 was the profit. So if we take 1,505, we divide that into the 18,600. That's 8% divided by 3. We do it per month, which is 2. So you made 2.69% a month times 12 months. Not bad. 32.36% annualized return.
So not bad at all. And then if you want to really factor in exactly how I did this, I did use one of my policies. So I pulled money from a policy. So over those 3 months while I had the money out, I paid about 1.5 in interest. You do the math on that. So you can reduce about 1.5 from those returns. However, the money in my policy obviously stayed compounding and growing for me the entire time. So at the end of
your policy is 3 years old, right?
Yes.
Did you do a dump-in into yours?
A slight one, yes. Not quite as big.
These are maybe not good examples, but here, let's just pull that back up. So it was the 3rd year. I'll just use this one. So it was the 3rd year that you used your policy to buy these forklifts. So the 3rd year right here, you made, if this was your policy, so I'm just making this up, but you would have made 111. So you essentially made 11.75% on the money there that year. So that's on top of that other one. And all we lose in the mix there. So, and this is where people kind of split hairs. They're like, yeah, but that insurance company, if I would have done that from the bank account, I wouldn't have to give the insurance company 5%. Wait, hold on, sir, ma'am. You made 11.75% that year on the insurance company. You had to give 5 of that back to the insurance company. What was your spread? Sorry, I'm having a hard time with math. 6.75% by the math, right? So you made 6.75%. Is your bank even paying you 6.75% on your money when it sits in the bank and the bank turns around and makes 500 to 1,300% more than you do? Just asking for a friend. Sorry. I mean, it's just, listen, sometimes that's the thing. Like, we've been doing this a long time, folks. You know, so that's just one example of Steven doing that. And we'll show a couple more because we've got.
Yeah, the cool thing is there's so many opportunities that pop up. I mean, we were talking about this morning on What the F, if you look at investing, what's probably the number one thing that we invest in? And we invest in ourselves. We invest in our education. We invest in attending masterminds to surround ourselves with the right people. We invest in our businesses to have something to grow in for the future. And one of the reasons why we are able to find opportunities like this is because of that investment in ourselves and surrounding ourselves with those kinds of people. And so, what we do with Private Money Club is, connections like this. That's what we do, is we bring this stuff to Private Money Club. And, given it's not vetted, it's not underwritten for you, although there are some services like that coming in Private Money Club. But, we were meeting with our developers last week on PMC down in Dallas, Texas. And, we were going over what are, outside of real estate, what other sections can we have in Private Money Club? Like, do people want to lend on vehicles? Do want like equipment like this? Do people want to lend on artwork, on, business acquisitions, things like that? And so just the more and more of these opportunities that come around. And then we're also going to start an internal investment club soon, which will include even more of these types of opportunities. So all I got to say is things like this wealth webinar right here, everything that we're doing, any of our coaching programs, just stay around the campfire, get around the campfire, stay around the campfire, and just implement, learn one thing and implement it. If one thing you learned today was how to become the bank, and you like the idea of using whole life that way, well, Chris just posted a link, schedule a call with our team. Let's get that policy started for you. While that policy is getting written for you and in underwriting, you can start learning about this other stuff that we teach, and you start snowballing it. It's a beautiful thing at the end of the day.
Yeah, so some folks were commenting that they tried getting a hold of ARC. ARC owns the company that we're talking about with the equipment flipping. So I want everybody to realize something. So the opportunity with there's 120 of you on, actually more than that, but it's not that he's got a small operation. He's got about a 40,000 square foot facility, which you can see by going to my YouTube and just find the video, or go to Be Your Own Bank or Be Your Own Banker.com, and you can watch the video. We're in the site, walking around. But the thing you got to understand is there's only so many forklifts. Now, I'm not kidding you. Like, I bought the first one that I did the video on, and then I couldn't get another video because Shauna and Joe and Brent and Steven and I don't even know, a whole bunch of people found out about this and went to ARC and bought lifts, and there was no lifts available. So I know that's really good returns and it sounds awesome. And, some of you probably want to do that. Just understand, like, you might have to wait, just like I did. I just did my second one. I just bought one of those Toyota ones. There's a video coming on my second one, but it might take a little bit of time. But definitely go to BeYourOwnBanker.com and fill out, there's like a little form you fill out, and they'll get back to you, but they might not have a lift for you right now. Remember, you're not investing in a fund. You're not investing in some speculative thing. You're buying the freaking equipment. You are buying the equipment. Steven bought those 2 forklifts. He owned them. He could roll up any day he wanted to that warehouse, and you got the address, and you could say, hey, where's my lift? It's over there in the paint booth. All right, I'm gonna drive that thing out of here. They could say nothing. You own the lift. You have you're owner. They're just facilitating the service of getting it all ready, getting it ready to be flipped. And they've got the network of buyers, and they've got the salespeople. And yes, they get paid for all of that. Like, you saw his invoice. Like, that's not free services. Okay, all the salesperson gets paid. All those techs, the paint booth guys, they all get paid. But the profit is the profit. You saw that was net. So it's not too good to be true, but it's good. So the more people that hear about it, the more people that want to do it, the more that we're going to just have to sometimes be patient. And here's the thing, like, don't go getting FOMO'd on it, because, like, listen, there's no fear of missing out. People will always need equipment. They're not going to stop needing equipment. Matter of fact, during a recession, people still need to lift heavy shit. During the pandemic, this was interesting. This is kind of how, ARC really kind of blew up. Like, even though everything shut down, guess what people needed? Guess what factories needed? Guess what Amazon needed? Lifts. Because more people bought online. They needed to lift more equipment up into those shelves and everything else. So they needed equipment. So just understand that if you call or get a hold of Ark and he doesn't call you back, like, he's just a dude, man. He's just a guy. He's not the dude that I'm always talking about, but he's a guy. And he's got his own small business. It's him and his partner, and they get back to everybody, but it might not be on your timetable. And they might not have a lift for you right away. But if you want one and you get on the list, eventually you'll get a call. Sometimes you need to bother them again. The squeaky wheel gets the grease. I had to wait months before I could get my second lift, because Mr. Joseph K, some of you know Joe, bought, I don't know how many of them, 10 of them. It's just like, I don't know, that's just is what it is. But that's the cool part. Like, that's the coolest part about the whole thing, is sometimes you just got to be patient and you'll win. Let's see, for trading, yes. So Ebony, this is an interesting one. Ebony said, couldn't one use the cash value as leverage for trading? Being the cash value loan doesn't have to be repaid, but always should. Whether you earn or lose, this is a risk-free option since the loss would be deducted from, no. A lot more to unpack there that we don't have time to really unpack. Yeah, Joe and his fleet of forklift and semi trucks. Ebony, probably what I would say, Ebony, I'm going to put the video and the link. Shoot, Stephen, can you put it up? I don't have it. We'll put the video. So right now we're in the chat. We're going to put a 90-minute video. Some of you have seen it. If you have, don't worry about it. If you haven't seen the 90-minute, I think you'll really like it. I have a brand new 90-minute coming soon, but this one's the original OG that's worked for probably 8,000 people. So it'll work for you. And then just book a call after you watch the video. So Ebony, like, I understand what you're saying there, but I'd want that unpacked a little bit more, because you're missing, I think I'm understanding it, but I think you're missing a couple of things on the trading side. The trading is independent of the policy. So I just want you to understand that, so that we're not getting you excited about something, then you're like, oh, it doesn't work that way, because I don't think it works the way you're explaining.
At the end of the day, it's where the foundation is of everything that we do with controlling wealth. Your money has to go somewhere. Why not into your own banking system, as opposed to, making the bankers rich, and these ridiculous banks, make so much money off of your money just sitting there. So why not just change that one thing where your money goes first? And when you really realize the power of that, you're going to want to do more and more and more of it. But the first step is just getting that first policy started, taking your first loan, letting our team help you create that plan and that money movement and what that looks like, recapture it, and then go from there. And, it doesn't just end with controlling our everyday savings and eventually more, with cash, but also how else can you take advantage of controlling your wealth? Or is it things like retirement accounts, which we don't have right now to go into like self-directed investing, but you can take a 401k, you could take an IRA, and we could self-direct that retirement. And now we can do all the same stuff with retirement dollars. So like that money I made on those forklifts, I'm going to pay taxes on. If I would have done that with my Roth IRA, no taxes ever on those 30%, 40% returns.
I think we can do something fun here. You never doubt me not to have something ready to go. Same thing with you. Like, I know you always have stuff. So should we just do because we got a couple minutes, should we just wrap this thing in 3 minutes? I know you can do this with your favorite of all time slides, because this is another thing. A lot of you are like, oh, I wish I didn't have all my money in my retirement accounts. I guess I can't do this. Well, here.
It's just a great example of, taking a simple concept, applying it, and being consistent with it. And it creates this predictable income return. And this was a case study from many years ago, but it's so relevant because there's a lot of people in the same position today. And just to kind of lay out the story real fast, I mean, Chuck and Mary Jones lived in Idaho and had a farm. They had a little ranch that they played with. But they had full-time jobs, and they were 10 years from retirement, had $350,000 in retirement accounts, but they had no desire to manage money, day trade, get into real estate investing and flipping and rental properties and all that. They just knew that they had to do something different, or they would never, ever be able to retire the way that they wanted to. I mean, $350,000 with 10 years to go, it's tough, especially when we look at today where the markets are, and there's very little potential for upside, in my opinion, in markets. And so they said, well, there's got to be something better to do. So what they did is they committed to continuing to deposit money. You go to the next one. So they continue to deposit into their retirement accounts. So they were able to put another $13,000 a year into contributions. And then what they did is they took that money each year and they started doing private money lending. Now, if you go on Private Money Club, the most common return, you're probably going to see about 12 to 15%. If you're working with a very experienced investor, they might offer you 10%. But Chuck and Mary at the time, they were lending, if I recall correctly, to family and friends.
Yeah.
So they said, listen, we understand if we do this the right way, we'll be able to hit our goals. We're not trying to rob you. We want you to have success also. So they decided to lend money at 9% annually on these real estate deals. Now their money was backed. They did this from their IRAs. This is called self-directed retirement investing. So their old 401ks, they rolled over in IRAs. Now they're able to do this. And they started lending on real estate transactions, private money lending, just like a bank does. Their money was secured in a first lien position by a mortgage and promissory note, just like a bank does. And these investors now paid them 9% annual returns. So what they did is they took that $350, they continue contributing. They lent it out over the next 10 years at 9%. And at the end of that time, they grew that $350 into just over $1 million. Now, $1 million at retirement is obviously a little bit better. But here's the beautiful thing about this is because of the nature of private money lending, especially once you build the right relationships and you do it time and time again, it becomes very, very passive. There's very little time and energy and work involved in doing private money lending in this way. And so they said, well, listen, even though retired, there's no reason for us just to start spending that $1 million nest egg. They said, this is very easy for us to continue to lend. So that's exactly what they did. And here's the cool part is because they know exactly what their returns are, they're not riding that stock market up and down wave and gambling and speculative investments and things like that. They know exactly they're going to make 9% annual doing these returns. They know that if they lend out $1 million a year at 9%, they're going to generate a $7,700 a month income for themselves, about $92,000 a year that they know is coming in every single month that they can count on to live. And that's without ever touching their nest egg. Now they can plan out their retirement a little bit. They know exactly how much they have to spend. And they know if they want to splurge on something that they're going to have to do something a little different. They're earning somewhere else. But now they can relax because they know exactly what's going on. The one thing that kills people literally is stress. Especially in retirement, you can't enjoy yourself in life if you're stressed out all the time. And money is literally the number one cause of stress in people in this country. It's the number one cause of the reason people get divorced and all these bad things happen. Ultimately, it's financial stress. And it's a sad thing because there's so many better ways to do things out there. So that's why I love this story, Chris, just because it's simple, but it just shows such a great example of what can be done very easily too this day and age.
Yeah. It's, we've done that presentation even longer than we've been doing the money multiplier presentation or the infinite banking stuff. So the original stuff that, me and Stephen did was, teach people how to be the bank. And this is even before we knew we could use policies. We were using retirement accounts. The only difference between using the retirement accounts and using the policies is the policies can pay you uninterrupted compounding interest. The self-directed IRAs cannot. Big differences, and I know some people were like, they were combining the two, but I just want everybody to know those are two separate things. One is using the policies, which is non-qualified money, the money that you save in a bank and whatever. The other one is money that maybe you have in an old 401k, an old IRA. Just so you can see that being the bank is basically about taking back control, not just the policy or a product. And we preach that and teach that all the time. And I still think a lot of people, especially financial advisors, constantly say, oh, it's just them selling a whole life policy. Like if you watch my YouTube content or any of our content that we do, we're always teaching a process, right? We're not just teaching a product. Sure, adding the whole life makes it work way more efficient. You just saw the mathematics behind it. But let's say we subtracted the policy and we use the bank account. Would that process still work? 100%. It just works better with the policy. So when people say infinite banking concepts is a product, it is not a product. It just works better with a product, and that product happens to be a much hated product, being whole life insurance, but it's designed and engineered to do a specific task, as we showed earlier. There's so much on YouTube, and every day we've got new ones going up, and they're getting better and better and more fun to watch. So if you're just here for the first time, check it out. Book a call with us after watching the 90-minute video, and that's mandatory. So let me actually not put the cart in front of the horse. You must I repeat that you must watch the 90-minute video before booking a call. If you haven't watched the 90-minute video, the call will be dismissed within the first 5 minutes of getting on the call, because we understand that if we get you on a call and we want to solve your problem, but yet you haven't spent 90 minutes to watch a video that literally lays the whole thing out, then you're putting the cart in front of the horse. And we're going to basically say, watch the video and then we'll get on the call. And then after you watch the video, mark my words, you will understand why you watched it. I know back when I was an advisor and I first heard about this, I wanted immediately to get on the phone. And, when I got on the phone with Brent, he said, have you watched the 90-minute video? And I said, no. And he dismissed the call. He said, watch the 90-minute video and then we'll do the call. I didn't want to watch the 90-minute video. I'm like, I don't have time for 90 minutes. When I watched it, I promise you, I swear to you, that video changed my life. Today, we did bits and pieces of it, but we just had fun today. We literally, it's like kind of Bob Ross. All we did today is we just painted a landscape for you. We just painted a picture, There are no mistakes. There's just happy accidents, right? That's it. Like, you can make mistakes all day long in the infinite banking process. And they're just happy accidents. You can always correct on them because you control everything when it comes to your money. You control the flow of your money. But if you continue to do what they teach you and what the society wants you to do and what, I don't know what you want to call it, but what they want, and keep using banks, keep using traditional financial vehicles, keep buying into the traditional financial advice that you're getting out there, you're going to consistently throughout your life, I don't know. I mean, you're just going to ride a roller coaster and you're just going to constantly be asking yourself, there's got to be another way. We just showed you just another way, just one of the different ways. We teach lots of different things. And today we just started with the fundamentals, the foundation, and that is your private bank. Because you got to put your money somewhere. You can put it in their bank or you can put it in your bank. That's up to you.
We completely forgot. We have a Black Friday special for you guys too. So we just did our test. Thanks for reminding me. So we just did our best 3-day training. We do something called the Money School Essentials 3-day training once a quarter. Typically, we've been doing it for like 4 years, since the beginning of 2020. And we just did our last one a couple weeks ago, and it's by far the best one yet. We brought in all new experts, all new content. We did some stuff on the first day, Friday, that's never been done before anywhere. And so it's really, really cool. But we decided to give you everything for over 90% off as a Black Friday special to get the recordings and some other content. So I'll put that link one more in the box, but it's a great place if you're like, I want more of this. I want to get it now. I want to really learn and dig into this, or even as a gift. If you're looking to gift, a parent, a child, a friend, some really sound financial strategies, and really want to get them into this kind of thing, buy it for them. It's $97. So hopefully that helps some of you, and you guys appreciate that. But that's one of our little things we do once a year. Typically, we find one of our best products and services and we try and give it away for Black Friday. So hopefully you guys enjoy that.
Yeah, and anybody that was at the 3-day, they'll tell you the same thing I'm going to tell you right now. And I'm not saying this just because it was me doing the training or us and our training, but that sincerely was the most spectacular money training we have ever done. And we've been doing this a while. And it's kind of funny. Me and Steven joke about this all the time. It's like every time we do one, we're like, oh, that was the best one. How would we beat it? But what we did the first and the third day in this training was literally something we'd never done before, especially day one. But it's something that's pretty timely too. You heard me talking a little bit about treasury bonds. So day one had a treasury bond strategy that no one has ever taught. It will hopefully go down in history as being the first time that was ever shown to anyone in the public. And that's what that link is. That's what that video is. And, we always like to, during Thanksgiving, pretty much give it away, which is 90%. And why don't we just give it away? Some of you are like, well, if you're in a giving mood and you're being thankful, why don't you just give it for free? I'll tell you why. If we gave that video to you, if we gave you that training for free, no one would value it. Nobody would watch it because you had no skin in the game. It just sitting in the inbox. But if you paid something for it, even though it's very little, if you paid something for it, it has value and you will watch it and apply it. I know it sounds broken, but that's just the way things are, folks. So that's why we charge for it. Okay. We'd love to just give it away. We give these this webinar and the video that comes out of this is free every week. And how much does this cost us? Well, Steven and I, an hour and a half. I don't know what we're worth an hour, more than I think anyone wants to pay. And not only that, like, it's not just our time. Then we have editors edit it, and we have somebody that puts it up on YouTube. So like, what is all that worth every single week? And how much money do we spend to get every one of you on here? 7,500, actually it's 8,000 now, 8,000 a month that we do in advertising for the wealth webinar. So this webinar was free. The training for the 3-day Black Friday special, it is not, because we want you to value it. So with that being said, folks, we hope to see you this afternoon at 4:30 Eastern for the Ask Me Anything. And that show's been going nuts. We've been almost 100 people on that show already. So it's just like these things keep growing. And again, just like I said in the beginning, I just want to give thanks to each and every single one of you for making all this happen. And let's keep this building. Let's keep new people showing up. Hopefully all of our first timers or even second timers on here, you got value out of what we did today. And if you did, we'll see you back next week. With that being said, thanks everybody and happy Thanksgiving. And thank you to all of our vets, our servicemen and women, and everybody out there doing the hardest work, which is protecting the freedom that we all enjoy day in and day out. So thank you to all of our vets, our servicemen and women, and anyone out there in the front lines. We appreciate you. All right, so I hope you guys enjoyed that episode. We're putting up tons of them, but I think if you like this one, you'll probably like that video as well. Not only that, I've got a book that I created, Mapping Out the Millionaire Mystery, where we actually show you what the wealthy do in the game they play with money. I want you to have that for free. And if you want to know about all my new videos coming up, click that alert button. Actually, smash that alert button, and you'll be notified every time we put a new video. So we'll see you on the next episode.